an agreement, or is this an agreement to try and reach an agreement? And based on that answer, how do the markets move from here?
It's an agreement to postpone the escalation that was planned for tomorrow and to continue talking over the next few weeks. So for us, I think it's right to temper the enthusiasm a little bit after such a huge rally we had on Friday. It's not locked down. Number two, even if we end up having a phase one written down truce, it doesn't remove the uncertainty cloud going into the election. And number three, we have also some just late cycle concerns to think about, which should come to the forefront as earnings season picks back up this week.
Krishna, tariffs that are already in place, they're not going anywhere. You still have this overhang of potential additional tariffs on more imports from China here in the U.S. come December. How does the market digest this?
Well, so I think the most important point to remember in this regard is for the markets to go higher. Given the policy moves that we have seen on the monetary policy side, we just need the trade issue to not get exacerbated.
Is that all we need?
Yes, that's all we need.
That's going to lift business and CEO sentiment.
I think there's the cyclicality of the monetary policy regime is going to kick in by the end of this year, and by early part of next year, so the outlook for growth is going to be meaningfully better. Rates remain low, policy is supportive, and economic growth actually stabilizes and picks up. The uptrend in the market has to be driven by that rather than the expectations of a trade deal. All we need is for things to not get worse.
Are you talking about the trickle down of Fed policy?
Well,
two cuts restores all faith in the world?
Well, no, it's not about trickling down of Fed policy. It's really about the Fed not tightening and making things far worse. I think if you go back and look at the slowdown in the first half of the year, part of it was trade-related, but a lot of it was related to what the Fed did in 2018. A reversal of that and support of monetary policy, not just from the Fed, from the ECB and world over. I think that's what the markets are going to be built off of.
And you've been focused on the strength of the consumer as kind of the bright spot here. And I know you've also talked about that being a life vest for this economy as it continues to chug along. Are there any headwinds that you see as it relates to the trade deal and the trickle effect that it has on the consumer?
Well, so I think the manufacturing part of the economy was slowing down for quite some time. And I think that, in my judgment, has kind of bottomed out with the reversal in policy. The consumer part of the economy continues to do very well. Income growth, unemployment, and debt load, debt service capability, all of that is very good. And I think that will continue to support the consumption for the foreseeable future.
So I think we also would agree that no escalation on trade and support of central banks, it does help to reduce the recession odds, right? So we are not of the base case that there is a recession. But we also temper a little bit our enthusiasm of how much these two variables can really lift U.S. and global growth from here. So for us, it's a story of muted economic and earnings growth, and as a result, positive but modest risk asset returns. So what?
I think that point is an important one. That is, even when you're looking for markets to go up, it's not, moving up in a big way. So our outlook for year-end is somewhere close to 3,100, which is not too far from where we are. But I think the outlook for 2020 onwards increases meaningfully because the global economy is bottoming out. Just go back and look at how things panned out in 2016. Once you have the policy, once you have the big odds kind of taken out, there is enough momentum in the economy for it to provide decent support.
So basically, you're talking mid-cycle.
Right? Absolutely, mid-cycle. 4 more years. So when I had come here before, I had said that this cycle will continue for another 5 years. That was last year. So 4 more years.
Right. And JP Morgan's nowhere near that, right? You're more of a late cycle case.
We are more of a late cycle case. And I think it'll be really interesting to start watching the third quarter earnings season, right? So away from trade, away from central banks, just looking at where we are in the cycle. And you're starting to see those margin pressures, right? We saw that in the first half of the year. And I don't think that goes away with a trade truce or with support of central banks.
That's sort of like the weird case right now, is that inflation ends up being the one that did us in.
Well, so if inflation picks picks up meaningfully, then it's all over. But I don't think the likelihood of that is very high. I think from an earnings perspective, let's just remember one thing. Focusing too much on third quarter earnings, actual earnings, as to what the future outlook is, I think that is misplaced. What you should be looking for is what people are saying with respect to the bottoming out that they are seeing in their respective businesses. That'll tell you what the outlook is for 2020, not what third quarter earnings were.
So, Gabrielle, do earnings expectations for 2020 need to come down, or do we just need to wait and see?
Absolutely. We still have consensus looking for 11% earnings growth in 2020. Even if we do have a bottoming out here in terms of growth, lower recession odds, the late cycle dynamics are still at play. You're not going to have margin expansion going into 2020. So these 11% earnings growth expectations do need to come down, into our mind, closer to something between 3 and 5%.
I think that argument crystallizes what's going on. Either it is late cycle or mid cycle. It's really not about trade. Trade is just a sideshow at the moment.
But neither of you are saying it's end of cycle.
Exactly. That's a crucial distinction.